Good Monday morning from Yahoo Finance's New York City headquarters studios. I'm Yahoo Finance executive editor Brian Sozzi. You're seeing those opening bells on Wall Street on this holiday week. Now, I know you are in the holiday mindset with Thanksgiving and Black Friday just a few days away, but I am here to say shake yourself out of the mailing it in mindset, because this will be a busy week for markets. We have retail sales data. Best Buy earnings are out, which will provide more clues on the holiday shopper. AI playing Dell's earnings are out just a few days from that swift post-earnings reversal in NVIDIA's stock last week. President Trump may announce an effort to bring down healthcare costs. All of this against the backdrop of a nervous market and crumbling crypto prices. We're going to lean hard into crypto and markets on opening bid today, so more on this in a moment. Let's get down to the NASDAQ, though, and check it with Brooke DePalma on the broader markets. Brooke.
Good morning, Brian. We're seeing a bit of a pop here at the open. All three major indices in the green. Taking a closer look, we do have the Dow moving ever so slightly higher this morning, up about 0.3%. The Dow up about 0.2%. The Nasdaq up about 1%, and the S&P 500 up about 0.6%. And this comes after quite a volatile week last week, as we saw that major swing in the markets. And one of the reasons behind that major moves is perhaps this risk-off sentiment that really hit the street, and that had a lot to do with Bitcoin and the moves that we saw there. If we take a look over the past 5 days, this has been quite the downward momentum for Bitcoin, down about 6%. And also keep in mind, this is, the worst that we've seen in Bitcoin over month. In the last 2 months alone, Bitcoin is now down 24%, and we are seeing a bit of a bounce off of that 80,000 threshold that we saw. That really was the bottom there so far. But if you take a look, this risk-off sentiment has since extended just a bit over the past 5 days across the NASDAQ as well. You saw this sell-off with NVIDIA, Microsoft, Amazon, Netflix, and some of the chip makers like AMD, Micron. We also had Palantir seeing some downward momentum. Now, at the open this morning, mostly green. NVIDIA trying to hold on to some momentum, but we see some of the big winners at the open, including Google, Tesla, and Micron. But once again, taking a step back, all three major indices to kick off this shortened holiday week. But what we do know is that there's lots of momentum and lots of factors going into this market, including that Fed meeting, AI, and also the holiday season, which I'm taking a closer look at as well.
So many factors, Brooke. All right, thank you so much. I appreciate it. Here's what's on my watch list right now. Eyes on Bitcoin. Bitcoin prices have entered the week with some stability, but it's fragile at best, given the shocking numbers surrounding the crypto market. Get this, the crypto market's total capitalization has now fallen by about 24% since its October peak. That's over $1 trillion in value, completely up in smoke. The correction in prices has seen long-term Bitcoin holders take profits. Blockchain data analyzed by Deutsche Bank show long-term holders sold over 800,000 Bitcoin in the past month, the highest level since January 2024. Goldman Sachs is not going full-on bear. Goldman Sachs strategist said today investors are moving away from a Goldilocks mindset on the economy fueled by AI growth and rate cut hopes. They say investors are dumping stocks because of concerns on the U.S. labor market and consumer, AI CapEx bubble fears, and less Fed resolve to cut rates into next year. But the backdrop to make money in markets is still fertile. Goldman says they recommend buying the dip in markets as the economy will likely stay solid in 2026 and the Fed stands to cut rates. Lots to get to here today. Here on the opening bid roundtable, David Miller, Catalyst Funds Chief Investment Officer and Senior Portfolio Manager, alongside Yahoo Finance Senior Reporters Brooke DePalma and Ines Ferré. David, coming out of the block for you, this Goldman Sachs note really has caught my eye. They are recommending buying the dips in the markets. Now, stocks are off their highs. Does buying the dip right now make sense to you?
I think it does. When you look at the Fed potentially cutting interest rates, nobody's talking about them hiking rates. You look at unemployment numbers around 4%, and you look at a situation where the federal government has basically created enough stimulus that they're going to be running a $1.8 to $1.9 trillion deficit over the next several years. I think that's a very good reason to think the stock market will do well over the next few years upcoming.
Ines, welcome back to the opening bid roundtable. We indeed missed you here. So what do you think about this Goldman note? I haven't seen investors really come out here and aggressively buy this dip. It's like they're nibbling around the edges.
They are nibbling around the edges. Thanks. Great to be back here from Spain. I will tell you, look, investors are expecting, the Fed to come in and sort of save the stock market. You saw the rise on Friday. And at this point, If the markets go down too much, then you start to see announcements. You start to see, the Fed getting more dovish. You have President Trump that has eased off of the tariffs on beef, on coffee, the $2,000 stimulus. So yes, the expectation is that you don't want to let this slide go on too much, this volatility go on too much, and you will start to see more dovishness, and therefore, you're seeing stocks rallying because of this. If you look at what happened on Friday, also, Soz, you look at even the consumer names that have been getting beaten up. Chipotle was up on Friday. You saw Macy's that was up. Even Dave & Buster's, which has had a terrible year, that was also up on Friday. So there is this expectation that the Fed is going to step in, and you also have the expectation that the government is going to do things to sort of goose the economy, so to speak.
Yeah, I'm not surprised by Dave & Buster's. It's too damn expensive to go there now. Ines, I can't help myself. You're in Spain. What are the prices like there?
I was in Madrid. They were good. I mean, look, you have. It was great to be able to eat out and better than here. They were better than here, even though the euro is a little stronger than the dollar. It was much better than being here. It was great. A great trip.
Good to hear. Good to hear, Brooke. Look, key to this, I think, what Goldman is saying is that the consumer doesn't fall off a cliff. And we've gotten some really mixed reads on all things consumer. Gap was good, TJ Maxx was good, Home Depot not so good in terms of earnings, Lowe's was so-so. This week we got Best Buy coming out. What's the read on the consumer here?
Well, Brian, we're going to get a slew more of data and read on how the consumer responded to all these earlier than expected holiday sales. We saw, Prime really come out on top, and then Target, Walmart followed. But right now we're waiting to hear from other companies as well, like Kohl's, Best Buy, Abercrombie and Fitch, as well as Dick's Sporting Goods this week. And National Retail Federation does expect the consumer to go out and spend big this year. They expect this to be the first holiday season where consumers will spend more than $1 trillion. And so there's certainly lots of momentum behind the consumer right now as they really sort of surprise the street with their ability to go out and spend. But as we know, this economy is really being propped up by that high-income consumer. That's a lot of what we heard last week, where that low-income consumer is still under pressure. Even Walmart pointing out that, yes, they saw growth across all income cohorts, but their low-income consumer was also under pressure as well. And also within this Goldman note as well, a weaker than expected labor market has certainly played into that factor in the fall here as well.
David, let me get over to you. How important is it that the AI CapEx narrative stays strong for next year? If investors aren't buying into that narrative next year, I mean, why won't this market be at least 10% lower?
I think if that were something that was likely to happen, that would be a very real concern. But we saw the last NVIDIA number. We can see the real demand. We can see consumers moving to using AI. I don't see the possibility that over the long term, technology is not going to be a bigger part of our lives. When you look at that persistent growth and demand in backlogs, I don't really see the scenario, even if there was a bit of an economic downturn, where you wouldn't see persistent and consistent growth for technology products.
David, real quick on this one, before I get to crypto. NVIDIA, of course, we saw that in reversal last week. Good earnings. Stock reversed, broader market got pressured. If Dell comes out, also an AI play, they work very closely with NVIDIA. If they report earnings this week and we see that same type of movement, what's your read?
I don't think Dell is nearly as much of a barometer for the market as NVIDIA was. If NVIDIA came out with weak numbers, it would have been disastrous. But I think the much bigger thing driving the market from here is any Fed statements on where they're going with interest rates. Any movement on the denominator for those rates, if they go ahead with cutting and do things to try to accommodate the market, I think that's what's going to really matter. I think the Fed now is actually more concerned probably not so much what's happening with the stock market or employment, but some of these cracks in private credit.
All right, let's hit crypto. That's very much top of mind. Had a good chat on the Opening Bid Unfiltered podcast this morning. New drop on our site. Talked to Coinbase's head of institutional, John D'Agostino. Here's what he said about what the pressure or why the pressure in crypto is happening.
One is just exhaustion. We had a massive run up going into October 10th. These large whales, these are people who bought Bitcoin at like 10 cents or $10 or $100, 10 years ago, viewed that 100K and all-time high as a time to start diversifying and selling their. So you're seeing a shift from very, very high net worth retail old holders to institutional.
Ines, where are the whales? Where have they been amidst the sell-off? Are they out there buying? What are they doing? What aren't they doing?
Yes, they like to sell high and buy low. But look, right now, it appears to be that you have Bitcoin ETF outflows that have reached 3.5 billion for the month of November. That is the largest since February. So what that's telling you is that institutional investors are on the sidelines. As far as we saw Bitcoin going down to around 82, 81, 82 on Friday. It then went up during the weekend. It's around 86 now, but the strategists that I've been listening to are basically saying that they're a little more cautious at this point. One is talking about resistance because he's saying, look, even though you saw a bit of a rally over the weekend because of the dovish Fed commentary about 25 basis points, he's saying that that's a hawkish cut, really. Unless it's 50 basis points and you see a lot more dovishness from the Fed, he doesn't see a V-shaped recovery with Bitcoin and with crypto in general. And then the other point is the AI question still, the angst over AI. If you see AI names or tech start to be volatile again, then you're going to start seeing that it'll be difficult for Bitcoin to sort of outperform in this scenario. But the question is, yes, when will you go back to all-time highs? I mean, we are right now down about 30% on Bitcoin since its all-time high in October. A lot has been wiped out. And until you get those institutional investors also back in and the whales in a meaningful way to come back in, it's definitely, it's hard to see that V-shaped sustainable recovery.
David, you overlay a chart of Bitcoin recently with the NASDAQ, and they've become very correlated. Is the reality that to arrest this broader market sell-off, we actually need to see crypto start to stabilize and go up? Is it that important? Is it now that important to the psychology in markets?
No, I think that's more kind of a tail wagging the dog element. When you look at what really drives Bitcoin and Bitcoin prices, clearly it's not like what we're talking about with equities, where it's what's happening with interest rates and how do you value it. What you see is it tends to actually correlate to equities in the sense that people like to buy Bitcoin when it's going up and they like to get out of it or feel pressured to get out of it when it's going down. So I think it's kind of the ultimate high beta asset where it's very likely to trend until that trend breaks because something in the equity markets in a risk-on environment reverses that sell-off.
Brooke, hop in. What are you watching for in crypto?
Yeah, well, what I'm watching is these crypto stocks. We are seeing a bit of momentum at the open this morning. Robinhood up 3%, Coinbase up nearly 4%. It's these companies that have largely experienced a similar sell-off because of the environment that cryptocurrencies, what we've been seeing as of the last week. And now if you take a look over the past 5 days, these are most of the companies that off of that sell-off of Bitcoin have largely been impacted as well. And now if you take a look at intraday trading, there is this somewhat of a renewed optimism within these particular stocks. But as you could see overall, taking a look at the broader crypto space, it's not experiencing that same momentum that we see within the trading platforms, seeing a bit of recovery this morning.
David, last word to you. Are you bullish on crypto for next year?
I'm lukewarm on crypto for next year. I'm very warm on crypto for the next decade. I think as the new generation comes in and their wealth grows relative to the older generation passing on, you'll see much wider adoption in crypto. And that's actually the key driver for crypto is how many people own it and how many of them own it, because there's a relatively fixed amount. So the next year, I think we're in a little bit of a situation where people have been cashing out, but the next decade, I think, will be very bright.
Good point indeed. All right, thank you, David Miller, for joining the opening bid roundtable. Brooke and Ines, you're stuck with me for a little while longer. Straight ahead, my stock of the day has this unwanted honor. It's the most shorted stock in the entire S&P 500, and I'm on the hunt for weird things happening in the economy, and I found something new we'll dive into. All that next. Welcome back. It's time now for my question of the day. Check this out. U.S. companies have sharply cooled their hiring this year due to trade uncertainty and cautious consumers. The economy lost jobs in June and August, and the average pace of job gains for the 3 months ending in September was only around 62,000. Yet, the productivity of workers remains high, and gross domestic product, or GDP, has stayed solid. My question is this: why does the disparity exist? And is it the most unusual economic circumstance at the moment? Let's take it to the opening bid roundtable. George Bory, Allspring Global Investments Chief Investment Strategist for Fixed Income, Brooke DePalma, and Ines Ferré are here as well. George, over to you. Why do you think this is happening?
Yeah, Brian, great. Thanks for having me on. There's clearly some meaningful sort of forces unfolding in the labor market, and the term low hire, low fire has been very much in play. We saw that in the payroll report that was much delayed but finally released last week. And the way we would categorize it is that we're still very much within the ranges of full employment. And what we're seeing is that companies are holding on to their older employees and they're slow to hire their younger employees. A lot of that has to do with AI and changes in technology. It has to do with the maturity of the economic cycle. And it also has to do with sort of changing dynamics as the economy itself changes to a new tariff backdrop, shifting dynamics in terms of demand, and just sort of overall population growth, which is slowing as less immigrants kind of come into the country. So some pretty big forces at work here. Is it unique? It's very unique. And it is not typical to see such a slow pace of hiring when you still have sort of the ongoing desire to retain employees. So we're kind of stuck from an unemployment standpoint. We sort of feel like we're sort of stuck right around that 4.5% range. We look like we're fully employed, but the underlying trend is telling us that the labor market's actually softening because it's having a difficult time absorbing a large number of young workers.
George, does that backdrop argue for any rate cuts? If we have a productive workforce, people are employed, score one for us older folks. I mean, we worked hard to get here, so good to see us still have our jobs. But does that argue for a rate cut in December and then a series of cuts next year?
So the Fed's stuck in an awkward spot. I'd say on balance, there's not urgency to move. And urgency in the sense that the labor market doesn't show as signs of collapse. It shows signs of some marginal weakness because of the mix of employment, but there's certainly enough folks that are looking for work, and there are enough jobs that are slowly being absorbed. So timing matters here. And with the absence of data for 2 months, it does make the Fed's job kind of tricky. Our view is that the Fed could easily pause next month, that they could wait 1 month, get better data, get a better handle on what the mix of hiring and firing looks like. The anecdotal evidence would suggest there's probably enough air cover to actually cut rates, but they don't need to move in a fast and furious way. That these are pretty long-term, they're gradual trends. They're trends that are slowly unfolding, and they're ones that are likely to stick with us kind of deep into next year. And it's not clear that a one-time rate cut in December or January is necessarily going to change the trajectory of that sort of labor market absorption rate, which is really what we're focused on and what we're concerned about. It's going to take many months to kind of find a new equilibrium. A little bit of easing along the way, can help. But as we know, the Fed is also contending with inflation that's meaningfully above target.
And as how my brain works is I saw higher productivity. I'm thinking more people are using AI chatbots. Companies are squeezing more work out of their aging workforce. This is all bullish for the AI trade. Why are these stocks off their highs, Ines? Come on.
Well, yeah, look,
go ahead, Ines. Go ahead.
It definitely, you have AI that is making everything more productive, right? And we know that companies are spending more on AI, so perhaps they can't hire as much either because they're spending more on that. But you also have the gig economy that is also in play as well, because you had Goldman Sachs, which Ali Canal had written about this. Goldman Sachs had talked about 15% of those who are counted as unemployed are actually doing gig work. They're driving Ubers. They're doing DoorDash. And so that contributes towards productivity, but these people are unemployed by all means and purposes. But certainly when it comes to the AI play, we are seeing it sort of in real time. You are seeing that companies, when they talk to Challenger, for example, in these surveys that they do, in these reports, they are saying that AI is the reason why they're not hiring. Costs being one, AI being the second one.
Inez fired up after her trip to Spain. Good to see Inez back on the roundtable.
That's right.
George Bory, thanks for hopping on the opening bid roundtable. Appreciate it. Now, I am rolling with a healthcare vibe for my stock of the day with good reason. President Trump is reportedly planning to unveil a new proposal for addressing healthcare costs as soon as today. This as his administration tries to avert a spike in premiums driven by the expiration of key Affordable Care Act subsidies. Against this backdrop, my stock of the day is a fallen angel in Moderna. Remember Moderna? The former COVID-19 high flyer has seen its stock plunge 43% this year as COVID vaccine demand has fallen and the company hasn't diversified quick enough. The company has also earned this unwanted honor. It's the most shorted stock in the S&P 500, according to S3 Partners. The percentage of shares shorted stands at a high 20%, according to Yahoo Finance data. For perspective, rival Pfizer's short percentage is at 2.2%. Speaking of Pfizer, here's what CEO Albert Bourla told me at Yahoo Finance Invest about his push into weight loss drugs.
We have the right to win in this space. We are a company that basically we made the primary care market. We are a company that we know how to run big, global, complicated trials with a lot of people in vaccines or cardiovascular. We are a company that know how to manufacture at scale. We have anything that is needed for us to be successful in obesity.
So, guys, of course, Pfizer trying to diversify its business, Moderna not so much, and Brooke, Moderna stock has been hammered as a result.
Yeah, and I was looking at the ratings on the street, and right now Moderna only has 5 buy ratings, 17 holds, and 4 sell ratings on the street. The average price target now sits around $36, nearly $37. And what we know is that this stock has come back to its pre-COVID level price. And largely, investors are just waiting for the next catalyst. They need to diversify away from just those COVID-19 vaccines, which Jeffrey says are down already as of November 21st, down about 24% year over year. And so clearly there is a need to get into other drugs as well. And what we heard from Citi is that there's opportunities around seasonal vaccines like seasonal flu, norovirus. Also, they're really looking to see Moderna make way within the oncology space as well. But these things need to happen in order for investors to really buy back into this company that, like you said, was a high flyer during COVID.
And it's not like Pfizer stock is ripping people's faces off to the upside here. I mean, it's not doing that. It's been under pressure, but it's good to see from a fundamental perspective, Pfizer diversifying its business.
Yes, and as you highlight, I mean, you are looking at 2 paths here. Pfizer diversifying its business, also talking about AI, and then you have Moderna. And it looks like there's blood in the water here when it comes to the stock price. I mean, you look at it and it's 420 peak from 2021. And look at where the stock is right now. The company has been in a cost-cutting mode. Cost-cutting is what they're talking about. And also there's been reports perhaps of a potential buyout as well. So as far as the COVID vaccine is concerned, nobody's talking about that vaccine. I mean, there's been, of course, distrust that's happened over the last year or so. But you go to any doctor and there's no doctor that mentions to you, you need to get a COVID vaccine right now. So certainly the stock price, it tells you the whole story, that chart that you're seeing right there.
The stock price is often truth. Brooke, Inez, thank you so much for joining the panel. Good to see you both on this holiday shortened week. Coming up, Julian Hyman has you covered on Market Catalyst. Do not go anywhere.